Hey guys, and welcome to today's video. So in today's video, we're going to be discussing an high probability ICT day trading strategy that's going to be a game changer for a lot of you, especially to finding consistency and profitability in the forex market. Now, when we talk about finding consistency and profitability in the forex financial market, we're simply saying you need to have a set of rules, a set of consistent rules that you apply day in, day out, or week in, week out, or month in, month out in the forex financial market, because only when you have a set of consistent rules, only then can you find consistency and profitability in the forex market. So without further ado, let's get right into it. So in this particular strategy I'm about to share with you, I actually eliminated a lot of things you need to pay attention to, things like daily bias, things like institutional order flow, things like swing institutional swing points. A lot of those things I eliminated all those single things. I just incorporated them into this particular process I'm about to share with you right here. And the reason why I did that is because I want a lot of you to actually take this particular strategy first, and especially those of you that have not found a particular model you are trading with. I want you to be able to take this particular strategy first and be able to apply it just following this simple step in any given market you are trading. But the particular market we're using for this particular analysis is the GBP USD, the pound. So without further ado, let's get right into it. So the only process we're going to be applying in this particular strategy is time and price. And this entire stuffs we are written out here is all the process we are going to need to ever implement this particular strategy. So the first thing we're looking out for is displacement, and we're looking out for this particular displacement between 5 p.m. to 6 a.m. New York time. So 5 p.m. from the previous day to 6 a.m. a new day New York time. So if you are using the MT4 platform and you are GMT plus one or GMT zero, that will be when the particular daily candle actually starts to when we're about to enter the New York section, which is going to be around 15 or 14, depending on whether we're having daylight savings. Good. So another time will be if we don't have a displacement between 5 p.m. to 6 a.m. New York time, we'll be looking out for a displacement between London session, which is 3 a.m. to 6 a.m. New York time. Good. So, but by all means, before we get into the New York session, we want to see a displacement in price. So, by all means, we need that displacement because you can see right here, I wrote notes. This displacement gives us a bias or confirms the bias. So, that particular displacement we are looking out in for in this particular time window, that's between 5 p.m. to 6 a.m. New York time, we're looking out for this particular displacement because that's going to give us the direction in price, the directional bias we're going to be focused on, or going to confirm the particular bias we already have outlined from our higher time frame analysis. Good. So the next area I want to focus on, or next thing I want to focus on in this particular analysis is a run on liquidity. Now we're looking out for this particular run on liquidity between 7 a.m. to 9 a.m. New York time. And now we're looking for this particular run on liquidity within this time window on the 15 minutes time frame. That's going to give us the entry. So if it happens before the 7 a.m. to 9 a.m. New York time, we're going to use fair value gap for entry. So let's say before we entered into the New York session, which is 7 a.m. to 9 a.m. New York time, let's say by 6 a.m. we saw the run on liquidity happen. Then what's going to happen is that going forward into the New York session, we're not going to be looking out for that run on liquidity anymore. We're going to be looking for a fair value gap to key off our level of entry. Now, when we key into this area of liquidity or fair value gap, we're going to be waiting for our entry confirmation, which is why I call a reaction in price. And I'm going to be showing you what that means for those of you who don't know it, but for those of you who knows it, thumbs up. So we're going to be looking out for a reaction in price on the 1 minute. Good. Now, once we get our reaction in price, we're going to get our entry, frame our risk to reward. So for those of you watching, you'll be wondering, okay, where will I put my exits? Where am I going to put my take profit? How am I going to exit the trade? So your exit is going to be the next draw liquidity, which is going to be the next high or next low, or it's going to be your fib extension 161.8 level if you're using the fib extension on the MT4. So without further ado, let's get right into the chart and see these examples play out. So right here on the right side of the screen, you can see I already have some shaded areas for examples for you. And these particular price actions are the ones I use for this particular week. So you can go into the GBP pounds if you're watching this video at the time of this recording. Today is 24th of November 2023. So you can actually go back and see these things for yourself. And I also recommend, if you don't trade the GBP pounds, you can actually see these things on your other pairs that you trade. You can test them out to see if they play out exactly as you want it right there. Good. So without further ado, let's continue. So right here, you can see this orange or brown shaded area right here. We can see this is between the 5 p.m. to 6 a.m. New York time. So this is when the daily candle actually started here on this particular platform. So it started from this particular area and it ended right here. So within this particular shaded area, we also have the London session, which is 3 a.m. to 6 a.m. So you just want to shade everything completely, which is 5 p.m. to 6 a.m. so that to avoid the confusions. So the next thing you are looking for is you are looking for a run on liquidity. So now looking at this particular shaded area right here and bring it across here, looking at this particular shaded area right here, we can see that we have a displacement where to the buy side. You can see even in this particular London session right here, the displacement is all the way to the buy side. Good. So you don't even need daily bias for this. You're already seeing your direction already. So that's why you're waiting for this particular displacement. So we already look out and we have seen a displacement in price. So all you're waiting for is to get into the New York session, which is the 7 a.m. to 9 a.m., which is this pink shaded area right here. And now on the 15 minutes, which is the time frame we are on, all we're waiting for is a run on liquidity. And right here, you can see as I shaded it right there, this is a swing low right here on the 15 minutes. Let me zoom that in properly for those of you that want to see that clearly. So right there, we have on this particular time frame, we have a swing low that formed just before going into this particular New York session right here. So this is 7 a.m. to 9 a.m. New York time. So on MT4 platform is going to be 14 to 17 chart time. Good. So without further ado, let's just continue. So we can see our price came down, run liquidity, run this particular low right here. So all we'll be waiting for is our entry confirmation, which is going to be a reaction in price. So let's go down to the 1 minute for that particular reaction in price. Zoom that in. So I'll drag this here and drag it open. So right here, we can see as price run the liquidity, which is this particular area right here, we can see the reaction in price. Price dropped into the area of it went up, came down, and went up. So this is the reaction in price, the W pattern right here. So the moment price came above this particular high, this is your entry. You enter this particular zone. Now, where are you looking to exit? You are looking to exit at the next swing high right here. So if you're looking for the next swing high, it will be this particular high right here. So let's say you enter this breakout structure right here, which is your market structure shifts. You put your stops below that low. You aim for this particular area. So this gives you a 62 pips stop loss, and you are exiting at a 118 pips for take profit. So you can see based on risk to reward, this is a very good risk to reward. That's give you probably almost a 1 to 2 risk to reward. And some of you say, okay, how can I cash this entire move in the entire session? So another way to do that will be using the fib extension. So using the fib extension, you take this particular high and take down to this particular low that ran this particular liquidity. So now the 100 and the 161.8 level is the level you want to aim for, which is this particular level right here. So there will be this particular level right here. So let's say I mark that out in time right there. And let's say you have your entry at around this zone. Let me zoom this in so you can see it for those of you wondering. So mind you, up here is our area of target. So let me just open this chart completely. So let's see it clearly. So right here, you can see we have the market structure shift. So here becomes your entry. Let me shade that area properly. So here becomes your entry right there. So you entered around this zone and you put your stop loss below that low. That'll be a stop loss of um 62 pips. Okay, 72 pips now, 72 pips. And you are looking to exit at 168. So you hold it all to this point. That's 218. So that'll be giving you a 1 to 2 risk to reward if you use the fib extension for your profit target. So without further ado, let's go and see more examples because I have more examples outlined for you all. So right here we have more examples. So let's look at this particular example right here on this particular day right here. That's to show you the reason why I have all these examples outlined is to show you the consistency of this particular strategy. So we mark out 5 p.m. to 6 a.m. New York time. That's from the previous day to the new day of the New York time. So what we're waiting for is a displacement in price. That's all we're waiting for. Now we can see our price displays going lower within this particular time zone. So let's say you didn't even understand what the higher time frame is doing, but you can see this play out within this period or this particular time window. This is all you need. Now, you don't want to see price in the New York session come and clear out the starting high or low. Let's say like now in this particular price action, we can see price displacing lower. So now you don't want to see in the New York session price come and clear out this particular starting high right here, because this is where the high actually, if price clears out this high, that invalidates the whole idea of this particular strategy. I'm not saying you cannot catch a trade if you do that, but it's going to invalidate the idea of this particular strategy, because this is how it should actually play out. Because the idea is that you are catching a retracement in the New York session. So we are not trying to catch a reversal. Good. So we are catching a retracement, but just that we are running a liquidity in form of a retracement and a reversal altogether. But the idea is that you're catching a retracement in the New York session. So you don't want to see price invalidate the starting high or the starting low. Like for this particular one previous price action here, the starting low will be this particular area. So you don't want to see on the New York session price come down and clear out this low and run up. That will invalidate this particular strategy. That doesn't mean you will not find a setup if that is part of your set of rules. But based on the rules of this particular strategy, we're not going to take such kind of trades. We're only looking to take trades that fit the criteria of catching a retracement in the New York session. Good. So we can see that we see price displacing right here. So this is the starting high, and this is where price displays to within this particular time window. So price started retracing. So this is the particular high right here. You see price failed to get to this particular area right there. So if I mark this out in time, that's this area right here. We can see that this particular retracement failed to take out this particular high. So this validates this particular strategy to be used in this particular day. Good. So all we're waiting for is on the 15 minutes, we're waiting for a run on liquidity. Now we can see that coming into the 7 a.m. New York time, we can see our price run this particular high on the 15 minutes. And all we're waiting for is a reaction in price on the 1 minute. And we're going to go down to the 1 minute to see that reaction in price. That's all we're waiting for right here. Let's do this. So right here, good. Boom. You can see our price run the liquidity, came down, give us a market structure shift, the M pattern. That is the reaction in price. So let me mark that out properly. This is a reaction in price right there. So you enter right here, you enter here, you keep your stops above that particular high at, okay, let's just say you keep it at 100 pips right there. So you can be aiming for this particular low right here at 328 pips. You keep your stop right here. Mind you, I tell you, your exit should be the next area of liquidity. Should be the next area of liquidity or your Fibonacci extension right here. So let's see. If you enter here, you put your stops here around 100 pips. That'll be where your stops is. So your take profits will be around here 332 pips right there. So let's say you use the fib extension. So let's use the fib extension. You can use the fib extension from this low to that particular high. Mind you, is a retracement. Mind you, this is a fib retracement for extension. So from this low to this high is the retracement. So your 161 level will be here, will be at this particular zone right here, 161 level right here. So you would have capitalized on the entire move on this particular day. So let's say you entered here, putting your pips around here, 100 pips stop loss. You'll be catching over 586 pips all the way to the sell side. So this is it. This particular strategy keeps repeating itself over and over again. So to further clear your doubt, I have a lot of examples as you can see already on the chart. So let's go to the next example very quickly. I'm trying to keep this video as short as possible. So it will be the next example right here. So on this particular day right here, we saw between the 6 a.m. to 5 a.m. Sorry, from the 5 p.m. to the 6 a.m. New York time, which is 5 p.m. to 6 a.m. New York time, we see this particular price action happen. So this is the starting low right here, and this is how much price traded high within this particular time session. All you're waiting for is a retracement, good, to an area of liquidity. You want to see price draw to an area, take out an area of liquidity, and we see that right here as going into this particular time zone. But mind you, I said you want to pay attention. If it happens before the New York session, you want to say you want to take your entry from a fair value gap within the New York session. Now, this is where the example plays out. So you can see our price drop here, taking out this low. But now this candle that took out this low, it is 13:45, which is going to be 6:45 a.m. New York time. So that doesn't fall in line with the process and rules of this strategy, which is 7 a.m. to 9 a.m. New York time. So what do? You drop down to the lower time frame, the 1 minute. All you're waiting for is a fair value gap. That's all you're waiting for on the 1 minute. So let's zoom that in right here. So you're waiting for a fair value gap. So you see price came down here, took out this low right here. Good. Now, if I zoom in properly, right there, let's get it. If I zoom in properly, you can see price gave us what a fair value gap right there. So I'm going to outline the fair value gap in price. There's a fair value gap right there. Now, as you can see, our price came into this particular fair value gap, went higher, came down lower, went higher. This is our reaction in price right here. So there can be your entry. You enter this point, your stops just above the below this particular low right here, or you can put your stops below the low that took out the liquidity. So let's say you put your stops. If I was trading this live, I'll put my stops below this particular low that run the liquidity because I don't want to see price run any other liquidity. So just to give you the benefit of doubt, so this is how I'll put my stops if I was trading this. So below this particular liquidity, and I also recommend you put your stops here. So where am I aiming for my exit? So this is 83 pips stop loss, and above this particular high, which is the next area of liquidity, is 190 pips stop loss. So that's a 1 to 2 risk to reward. This particular strategy plays out consistency. Now you can see just this all price action is just within 1 week. I'm giving you guys this stuff. This is going to be a game changer for a lot of you. So that example out of the way, because of time, I'm going to just be going through this whole um, process very, very fast. So back to the 15 minutes again, we can see, I believe you already know the process by now. This is 5 p.m. to 6 a.m. New York time. This is the starting low. This is a high we traded with. So in other words, we have seen price displaced to the buy side. So our bias is bullish. All we're waiting for is a retracement down to the sell side. Price came down, took out sell side liquidity right here. Good. Now this happened before this Q zone, the New York Q zone, which is 7 a.m. to 9 a.m. session. So what we do, we use what? Fair value gap. Good. We use fair value gap right here. So I drop down to the lower time frame. I zoom that in, drag that out in time quickly. Let's drag that out. So looking right here, we can see the price around this zone didn't really give us a fair value gap right here to trade with, because we can see price took out this low right here, and getting into this particular area, price didn't really give us much of a fair value gap right here. But we can see that before the session ended, price came down, running out all this particular low. So there are going to be days like this. Good, there are going to be days like this. So what you want to do is you want to capitalize on this particular move right here. You want to wait for this particular move right here, especially when you are not seeing a obvious fair value gap. Good. Like here could be a fair value gap for most of you. This particular area could be fair, but for me, it's not very obvious. So I'll kind of ignore that and wait for um price to run all the liquidity that it has created, and which should be this zone right here. So you can see how price run the whole liquidity, went higher, gave us a fair value gap around this zone here. Give us a fair value gap around this particular zone right here. Price went up, came down, took out that high. These are our entry pattern right there, which is our reaction in price, also known as market structure shifts. So your stops should be below the load around the liquidity, which is this low right here, 94 pip stop loss. While you're looking to exit, you can aim for this area of liquidity right here, which is going to be, which is not going to be a very good risk to reward. So we're going to use the fib extension instead. So we take from this high down to this particular low, and we're aiming for the 161 level right there. 161 level right there. Good. That's the 161 price level right there. So let's say um we entered around this zone, that point. I will keep our stops below that low, which is 85 pips. We're aiming for 161 price level, which should be giving us 196 pips to take profit. So we risk a almost 100 pips, which is 82 pips, and now we are gaining 196 pips to the buy side. So that's a very, very good risk to reward right there. That's 1 to 2. So more examples loading, more examples. Let's look at them very quickly. I think we already have two left. So let's look at it before we wrap up this video. This is just to strengthen the idea in your mind. So back on the 15 minutes, we can see now here it becomes very tricky. Here becomes very tricky. And as I say, you want to focus on also on the London session too. You want to say if you don't get the displacement in the complete session, you want to say you can look for displacement in the New York session. Good. Now because within this particular time window, you're expecting all the whole manipulation in price to happen. You get that's what you're waiting for within the 5 p.m. to 6 a.m. New York time. You understand the 5 p.m. to 6 a.m. New York time, you're waiting for the whole manipulation to happen. So you can see here, this is the highest price and this is the lowest price. So at this particular point now, a lot of you will be tempted to go to the sell side. I don't get to now, you'll be tempted to go to the sell side. But now if you focus on the London session, this is the London session. You can see price came here, took out this particular low on the sell side and displaced to the buy side. So price coming down, retracing into the New York session. Mind you, the idea is you want to focus on that retracement in the New York session, into the New York session. Rather, you want to focus on a retracement into the New York session. So in other words, if a low has been created, I don't get now, and a high has been created, you want to see how price retrace within that given range. So the given range is this high to this particular low that happened in the London session. Though this is the high, and this is the low, and the magnitude of the move has been to the sell side, so we could be tempted to push price to the sell side. But based on the idea of this particular strategy is a retracement into the New York session. I don't get that we are trying to catch, not a reversal. We're trying to catch a retracement into the New York session. And with that in mind, we can see that this particular low to this particular high that happened in the London session is the range that we're working with. So this is your dealing range. This is the dealing range we're working within right here. So price came down here, taking out what? A low, a run on liquidity. Now we're observing that particular area, and the best way to observe is to go down to the lower time frame. We're waiting for a reaction in price right there. Oh, that's all we're waiting for. So clean and sweet. That's what we're waiting for right there. So let me just do this fast. So we can see how price run liquidity came up, went lower again. Now price came higher. Now he has taken out this particular high. Price came down again, eventually taking out this particular high right there. So now here becomes our entry. This zone right here becomes our entry right there, all the way to this. Let me get this, all the way to this particular low. Now this becomes 448 pips. That's what we are risking on this particular trade. Where are we looking to exit? We're looking to exit at the high that this particular session created here. This particular high here, this is what we're looking to exit. So if we are to exit using that high, that will be, we're exiting at 269 pips. So we are risking 147 and we are getting out at 270. Okay, let's just say 270 pips. So for me, this will not be somewhat like a very, very good risk to reward. So what I'll do is I'm going to take from this high that started the retracement, I'll take it all the way to the low, and I'll be looking to look at the 161 um 161.8 extension level. So if I look at, I take out here 147, that's my risk, my stop loss. I'm looking to exit around this area 354. So that's already a 1 to 2 risk to reward. So I believe you're finding value in today's video. I believe. I'm very sorry and I apologize if I'm going over it too fast. I'm just trying to keep the video as short as possible. I recommend you watch the video a couple of times to really grasp what I'm saying. So this is the last example for this particular video. So you can see that this particular one, we saw a run on liquidity right here before the session. So you want to wait for a fair value gap. And you can even see on this particular time frame, we already have a fair value gap obviously created right here. So this is a fair value obviously created. But now I intentionally outlined this particular one because you can see the way price went above the fair value gap and almost taking out this particular high right here. It took out this particular high right here, took out this high that took out this high right here, looking as if it defiled the particular fair value gap. But if you look at it on this particular 15 minutes, you can see the way the bodies of the candles respected the fair value gap. So that shows the strategy still works. So this is just price manipulation. So let's say you got wicked out, you got knocked out, You know what I'm saying? But if you're watching price in time, you can still get another chance to get in back in sync with price. So what you're going to do is you're going to go down to the lower time frame right there. You're going to go down to the lower time frame. Let's get our price right there. So let me zoom this in. So right here, you can see we came into the New York session right here. So we went higher into the fair value gap, came down, price went up. So you can see price didn't really come down to take out this particular low to give us our entry right here. So let's say some of you must have entered in this low because this would have been a very good pattern. For those of you that entered at this reaction in price here, let me get to the area. So for those of you that entered at this reaction in price, let me make this white so it will be more clear. Oh, that didn't really solve what I wanted it to do. So, okay, let me give it another color. Let's try black. Let's see. Okay, that's nice. So those of you that entered at this reaction in price, that's this M pattern here. So would have gotten wicked out with this whole move to the buy side. I don't get it now. But those of you that waited, um, trying to use this particular low after this deeper retracement into the fair value gap, you'd have been spared. I don't get it now. But let's take the scenario of those of you that got wicked out. So let's say you got wicked out around this particular area. Applying proper risk management, probably you lost 1% of your account. Very, very good. No problem. You get that's trading. So price went higher, knocking you out, but price came down now, giving you a complete market structure shift. So at the close of this particular candle right here, you now have a new high. I'm sorry. Let me get this properly. So you now have a new high. So your risk there is around 222 pips right there. Good. So now you're risking 222 pips. Now there's no obvious low like in near sights to get out of. Now this is where fib retracement comes in very, very handy. So you want to catch the whole retracement. Now that is what you do here. Now this is your 61 point it's 61 161.8 level right there. So you mark this out in time right here. You mark this out in time. So you risked 222 pips and down to 100 and to this particular level right here is 161.8 level. So okay, sorry, this will be it here. So you entered at the close of this particular candle. Sorry, we're correct earlier. So you got out at 170 pips. So this is actually not a good risk to reward, especially if we use the fib extension. I don't get now. This will not be a good risk to reward, but probably if you have held to the end of the session, you could have recovered all. But let's just use following the rules. You want to say that's holding on just to 161.8 retracement level, extension level rather. Good. That will be probably you just recovering a portion of the amount you lost. Then coming forward into the next day, you're going to probably see how you engage. So that's part of trading also. You know what I'm saying? Some days you're going to recover almost the risks you lost. You already get now. And that's trading for you. You get what I'm trying to say? But you can see the consistency of this particular strategy. And that's the idea I'm trying to communicate to you in this particular video. You can see the consistency of this particular strategy. So going over the particular process again, I just wanted to see just a process of time and price. We're looking for displacement between 5 p.m. to 6 a.m. New York time, or we want to see a London session displacement between 3 a.m. to 6 a.m. New York time. Good. So if we see a London session displacement to work within that particular range, so that'll be our daily range. So this displacement gives us a bias or confirms our bias. Good. Now, for entry, we're looking for a run on liquidity between 7 a.m. to 9 a.m. New York time on the 15 minutes for entry. So if it happens before this particular given time, which is 7 a.m. to 9 a.m., we're going to use the fair value gap created. Good. We're going to use the fair value gap created. Now, our entry confirmation is going to be a reaction in price. This is going to be the M pattern or W pattern. And that's going to be, we're going to be looking out for that on the 1 minute. Now, our exits is going to be the next drawn liquidity, which is going to be a previous high or a previous low, or a fib extension, which is 161.8 level. So you can see it's with the consistency of the examples I just shared with you. And these are just recent price action. You can go on to backtest this as far as you want, probably even using trading view for your own use case. You know what I'm trying to say? But this is me just telling you that this particular strategy actually works. So if you want to find consistency and profitability and you're looking for something to get started with, I recommend you can get started with this particular strategy. And if you find value in today's video, hit the like button, hit the subscribe button, and see you in more videos.